Welcome back to the Core Curriculum Show. I'm your host, Crawford Anderson. I'm the founder of AWM Financial, and I write a weekly personal finance column for the Niner Times. I'm here with my co-host, Thomas Wong.
Hey, I'm Thomas Wong. It's some great weather outside.
Yes, it is.
Crawford, what are we covering this week?
So this week, we're going to be going over part 4 in the Core Curriculum series, From Dynamic Dinnerware to Enticing Entrees. We're going to be talking about the other big indexes in the U.S. stock market.
So yeah, we went over pretty heavily the S&P 500 a couple weeks ago, or whenever that episode comes out. And now we're covering the Dow Jones and the Nasdaq.
Yes, the Dow Jones Industrial Average, which is actually the oldest index in the United States. It was created in 1896 by Charles Dow, Edward Jones, and a few other fun fellas. That was back when the market was a lot smaller. It's only 30 companies large.
Yeah. So the Dow Jones is the 30 largest companies, or how does that work?
So it's actually chosen by committee. It's meant to reflect the biggest, most stable companies in the U.S. They're known as defensive companies. So these are not your typical startups. These are very well-established companies. They've been around for many years. Typically decades is the best way to measure them, not in years. They're the most well-known companies. In fact, most people would recognize most of the companies in the index. So you got your Apple, your Microsoft, your Amazon. Those are the big tech companies that make up the top of every index these days. But then you also have your Costco, you have T-Mobile, you have Gilead Sciences, which does a lot of pharmaceutical stuff. You have Texas Instruments, which makes that TI-84 that you dread opening up in calc class. You have Honeywell, which is actually headquartered here in Charlotte. And I'm realizing that's not even true. I was looking at the wrong page. But a lot of those are represented in the Nasdaq 100 as well as the Dow. Honeywell is in the Dow, but you also have Visa and JP Morgan Chase, Coca-Cola, Home Depot, Caterpillar, a lot of large companies that most people have heard of. We'll circle back around to the other ones.
Yeah, why don't you name all 100 companies for it? So something interesting with the Dow Jones that's not like the S&P 500 is that they're price weighted. The 30 companies are price weighted, which might change the diversification of, what you should expect.
Yeah, absolutely. So in the last couple of weeks, we got to go over the S&P 500 and how that was price weighted, as well as how to actually buy the stocks that we're talking about and how to actually invest through your brokerage, which is like a bank, but where you can buy and sell stocks and ETFs. But this week, we're going to be going over how the Dow Jones and the Nasdaq are different. And one of the biggest ways is how the Dow Jones Industrial Average, we'll just call it the Dow for the future reference, is price weighted, which means that the top companies are not the largest companies by like the value of the company on the market, but it's by the actual price of the shares, which nowadays is less relevant because we can buy fractional shares. You could buy even just $1 of your favorite company.
Yeah, and before this, we were talking.
Yep.
And we were going over what the biggest companies were in the Dow Jones by how much you're buying into.
Yeah.
And what were some of those companies?
Yeah, so if you look at the S&P 500, the largest companies are, we call them the 5 that drive, or the Magnificent 7 is another way to call it. You got your NVIDIA, your Tesla, your Google, your Meta, which is Facebook and Instagram. These are all companies that most people are familiar with.
Yeah.
But in the Dow, the largest companies are Goldman Sachs, which is a really large bank, Caterpillar, which makes those big backhoes and all that other good stuff they have, Microsoft, which is another big tech company, Home Depot, but Sherwin-Williams, which is a paint company, I think, American Express, a credit card company, Visa, and JP Morgan Chase. So a lot of companies that are a little bit more old world, less of a they're less relevant these days, but they still make up big proportions of the Dow Jones.
And just like what your article said, it's picking different entrees, picking different meals,
Yes.
You're getting something different when you invest in something like the Dow Jones.
Yeah.
And that also means the percentage growth that to expect from investing in the Dow Jones is also different.
Yeah, so the Dow Jones goes back to 1896. It was the first index created, and it has a very long track record, but its long-term average is somewhere around 7 or 8%, although that has increased recently as more tech companies have been added to the index, like NVIDIA, Amazon, and Microsoft. But the difference between like the S&P 500, which is 500 of the largest profitable U.S.-based companies, and the Dow, which is also profitable U.S. companies, I don't think we mentioned that, is that it is more of defensive companies, if that makes sense. So companies that are more stable, they're going to be slower growing, But when tough economic challenges happen, when there is a recession, those companies are far more likely to continue being profitable and successful than some of the companies in the S&P 500 because they have a really long track record.
Yeah, and something like, I mean, when we talk about these stable growth companies, these are consumer staples. These are companies that, profits don't really change. Like Sherwin-Williams, people will still buy paint.
Yeah, you got to have your paint. You got to have, like Chevron is in the index. You got to have your gasoline. Nike's also in there, and Verizon. These are all the things that we all buy on a daily or weekly basis. These aren't like one-off purchases like a movie theater where you might not go to a movie, but you're still paying your phone bill.
Yeah, no one's like, it's a recession, so I'm going to stop having mobile data.
Right.
So you're, in a way, reducing your downside.
Yes. So while it's not guaranteed that nothing's guaranteed, right? Looking into the future, we can't predict the future, unfortunately. But generally speaking, Dow Jones companies are going to be more stable, more defensive, less risky, although there's still some risk. Not every company is going to be around forever, but generally speaking, they're going to be less risky than maybe your technology companies or your startup companies.
And this is a great transition, but comparing that to the Nasdaq, how do these defensive stocks compare to what the Nasdaq has to offer?
That's a great segue, because if you think of the S&P as like, that's just the market, that's the general, that's the base, that's like the bar basically. If the Dow is kind of more defensive, the Nasdaq is a little bit more aggressive. They're more focused on growth. So there's two things to think of when you hear the Nasdaq. There's the Nasdaq Composite Index, which tracks all stocks traded on the Nasdaq Stock Exchange. And we're going to go on a brief tangent for a minute. There's two main stock exchanges in the U.S. You know what the other one is?
No idea.
Okay. The New York Stock Exchange, which is in New York. I've actually been there. It's very cool. And the Nasdaq, which is also based in New York. But generally speaking, when a company wants to go public and offer their shares to the public, like we always say, your grandma, your grandpa, and their friends, or us, they will either list their shares, which means go put them for sale on the New York Stock Exchange or the Nasdaq exchange. And generally speaking, technology companies prefer to go public on the Nasdaq. For general brand image purposes, it's kind of known for being a little bit more growth and new age, a little bit.
Yeah, it's a new kid on the block.
New kid on the block, absolutely. So the Nasdaq Composite Index tracks all the stocks that are listed on the Nasdaq Stock Exchange. That's about 3,000 companies. That's a lot.
Yeah.
That is important, but we're going to focus on the Nasdaq 100, which tracks the 100 largest companies on the Nasdaq Stock Exchange, and it excludes financial companies. So it's only really technology companies.
So like the S&P 500, is the Nasdaq 100 a market weighted, or is it like a Dow Jones where it's price weighted?
So it's market cap weighted. So the largest companies make up the biggest percentage of the index. I'm going to read the other list I was looking at earlier, which is actually the Nasdaq this time, and you're going to hear some familiar names again. So at about 14% of the index is NVIDIA. They make up a really big part of it. And then you have your Apple, Microsoft, Amazon, Google, Meta, which is Facebook and Instagram, Broadcom, Tesla, and actually Walmart recently moved over to that index. So that's the top 10, and those are more growth-focused companies. Walmart less so, but they still like to be on there because they have their e-commerce side, and it's a lot of brand image for these companies too. Walmart wants to be seen as, hey, we can still grow. It's like if your dad starts trying to listen to like hip music.
Yeah.
And it's like he wants to look young again. Yeah, maybe it doesn't look the best for him, but he's trying, right? He wants to be the new kid on the block again.
Your dad's on TikTok. He's not that hip, but he can join, I guess.
He tries. Hey, nobody's gonna stop him from creating an account, but maybe he shouldn't.
So the Nasdaq 100, I have in my notes that it has a 13% average return.
Yes. So
what is that return over, since it's largely tech weighted?
So in the last roughly 30 years, just over 30 years actually, the Nasdaq has done really, really well because technology has become the center of all of our lives, right? You have the internet boom, the software booms, and the mobile phone era, where you can take your phone, which is basically a mini computer, and go anywhere you want and have mobile data. And now you have AI, which is the next big wave of technology. Although we can't predict the future, although we always wish we could, it does look like technology is going to be the future. However, in the past, technology companies have had huge booms, like great times, They've also had really big fall offs. In 1999 to 2001, the Nasdaq lost over 50% of its value. It took 15 years to get back to its original all-time high. So I believe it was sometime in 2015 that happened. So if you had invested in 2001, you would not be doing well for a very long time. So that's the risk of investing in the Nasdaq, is that yes, you had the potential for higher total returns, but you're also going to see a lot more volatility. So unlike the Dow Jones, where you're going to have kind of a slower upward approach, it's going to be more wavy. So 1 year where you have great returns, 1 year where maybe you've lost a lot of money.
And this goes back to a message that we're trying to reiterate, not just to ourselves, but to everybody listening, about investing, Invest for the long term.
Absolutely.
Even if you invest in the Nasdaq 100.
Yeah.
Say it's over 15 years. If we're investing now, we'll be 35. We have 20 more years in the market of growth returns. You know, it doesn't matter what those 15 years look like. So invest for a long-term stance, not, 2 years down the road.
Yeah, and there's always talk of like a bubble. If you've ever heard of the technology bubble, we'll talk about that more in the future, but there's talk of an AI bubble. And well, I absolutely cannot predict when that may or may not happen. It might never happen. There's always that possibility, right? We don't know what's going to be around the corner tomorrow, let alone next year or 5 years from now. And so if you're our age, you're 19, 20, 21, somewhere in there, and you're saving for a house or for getting married or something like that, you definitely want to be careful to not invest in the stock market, especially something high risk like the Nasdaq, where you face the potential of another 15 years of not having any profits.
Yeah, that's a great point. And we can't just, throw money everywhere. So we invest in something like the S&P 500, the Dow Jones, and the Nasdaq, but we invest through something like a QQQ, which is something you hear a lot more often.
Yes, so that's what's called an ETF. And while we talked about that in the last couple of weeks, we'll go over it again briefly. An ETF allows you to buy what's called ticker symbol or a share. It's like a stock, and you can buy one thing, and then an investment company will go on your behalf and go buy a bunch of companies for you. So with the S&P 500, they will take your dollar or $100. We'll call it $100 for this example. They'll take your $100 and they'll go split it between all 500 components of the S&P 500 for you. They'll charge a little fee. That's called an expense ratio. But then you don't have to worry about buying 500 different shares, because that would be exhausting and a lot of work. There's the same concept for the Nasdaq, and the ticker symbol on the biggest ETF for that is QQQ. And what QQQ is, they track the Nasdaq 100. It has a expense ratio of just 0.18%. You might be wondering, what is that? That means that for every $10,000 you have invested into that fund, your $18 of profits per year would be paid to the investment managers so they can do their job. That doesn't seem like a lot, but we know because of the power of compounding that small dollars add up to a lot over time. And so $18 every year can add up. But you're not actually paying that fee out of pocket, right? It's not the end of the year you get like a bill from QQQ. That just comes out of the profits of the fund. So any dividends or gains on the shares in the fund, they'll just take a little bit out of that.
And so these expense ratios would be like, if I'm charged that 0.18% expense ratio, that's saying for them on my behalf of going and investing in stocks and doing their job, they're just going to charge me a little bit of it.
Yeah, and it's fair, right? I don't want to go spend all my day buying 100 different shares and the exact right percentages and changing it whenever it changes. That's a lot of work. It's a very good deal for us. That doesn't mean you can't still find better deals, right? So we're going to take a look now at some of the main ETFs that track the three major indexes and kind of give you a brief overview of what those are.
Yeah, and I would like to say, just to add on to that expense ratios aren't like bubble rates where it's a flat rate year round, It doesn't matter what, the Fed does if it lowers or decreases interest rates, that it will stay flat.
Yes.
So it's a little bit of reassurance there.
Yes, very rarely do expense ratios change, and when they do, it's almost always less.
Yeah.
They get cut. And that's usually because of competition. So if you go back to the 90s when the first ETFs were introduced, expense ratios were a lot higher because there was more work to be done. Not everything was automated like it is now. And there was less competition. But as competition came onto the scene, other fund managers said, hey, we can lower our cost by a little bit and attract more assets to our management. So the largest S&P 500 fund is what's called SPY. It was introduced in, I think, 1996.
Sounds about right.
Yeah, that sounds about right. And it is very large. There is over $700 billion that are invested in that fund. It has an expense ratio of just 0.09%, so it's very cheap to own. It also has a lot of volume and liquidity. And we're going to circle back around to that. So write that down, Thomas, and we'll come back. But the largest Nasdaq 100 fund is called QQQ. It has an expense ratio of 0.18, so it's a little bit higher, but still relatively cheap, right? Most ETFs are going to have an expense ratio of less than 0.5%. So that's very cheap generally. And that has a assets under management of $410 billion. That's a lot of money.
Yeah, it is.
And then the Dow Jones Industrial Average, there's also an ETF that tracks that. We're going to include it, but I don't believe either of us own that.
I don't think we do either.
Most people don't. In fact, they only have $44 billion of assets under management and a 0.16% expense ratio. So it's also relatively cheap. But very few people actually buy the Dow Jones Industrial Average. It's more for people who are seeking safety rather than high growth. And for us at our young age, seeking more volatility and risk while getting a higher return is usually a pretty good idea.
Yeah, so two specific things you pointed out there is volume and volatility.
Yes.
And so what does that have to do with the NASDAQ, S&P 500, and Dow Jones?
Yeah, so volume is really important. That's the amount of shares that are actually traded per day. So let's say I have $100 and I buy one share of SPY from you.
Yeah.
That means that one share has now been traded. But oftentimes, we as investors want to buy and sell shares all the time. Maybe every Friday you want to invest a little bit and you want to buy a couple shares. That means there needs to be willing sellers on the other side of your trade. Somebody has to be actually selling you those shares, which means you want a ETF with a lot of liquidity. That just means there's a lot of people in the marketplace all across the world who are trying to buy SPY. And SPY is very good for this. In fact, their average daily volume is 82 million shares traded. So when you're trying to buy your one or two shares, there's going to be somebody out there selling them to you.
Yeah, exactly. You don't have to worry about connecting with a seller.
Absolutely.
Because a lot of things people and investors forget, and even me, I forget this, is that when I'm buying a stock, there has to be a seller stock that I'm buying it from, you know?
Yeah. It's kind of funny to think about. There's somebody out there who's actually selling that to you. And sometimes it may be a really large institution. They might be selling many shares and you're just buying one of a lot, but there is somebody on the other side of that trade. But that brings us to two other funds called SPYM and QQQM. They both track the S&P 500 and NASDAQ respectively. You can kind of tell with their different ticker symbols by just having an M at the end. But they have much lower expense ratios. So SPYM has an expense ratio of just 0.02%. That is the lowest that you're going to find just about anywhere, and that's significantly lower than SPY. And even though it's only about $7 per $10,000 invested difference, saving that money every year will build up over the long run. And once you become a millionaire, like the 25-500 plan that we've talked about in the past kind of talks about, that will be a lot more money. I mean, let's see. That's 150 times 7. That's going to be almost $1,000 a year that you would save by investing that into SPYM versus SPY. But the difference in that is that SPYM has a lot less shares traded per day at just about 11 million.
So it's a little bit scarier because you don't know if you can connect with that seller if you're trying to get out. Yeah,
and so for us, when we're buying one or two shares, not too many shares, it's actually very easy for us, right? We're just buying a couple. But if you're a bigger trader, you're a bigger buyer and seller, you need that larger amount of liquidity in SPY, which is why that fund continues to exist and why you pay more for that privilege is because they have that liquidity.
Yeah, so say there's an old man and he's worth $50 million.
Yes.
You're moving large sums of money and a lot of shares out, and it might not be possible for you to liquidate all your shares at that time.
Yes. QQQM is very similar. They have an expense ratio of 0.15, so a little bit cheaper, and liquidity of only 5.5 million shares traded per day, which is less than a tenth of QQQ.
That's crazy.
Yeah.
So what we're saying is, I don't think it's an issue for us if we're planning to hold something like the QQQM or the SPYM.
Yes, we want to buy and hold those for a really long time.
Yeah, so it doesn't matter that there might not be a lot of sellers there.
Yes.
Because you're buying in expecting in 20 years to sell, you know? But if I guess if you're taking a more short-term look, SPY would benefit you more.
Yes. Yeah. Although we don't encourage short-term buying and selling, we definitely want to focus on buying and holding stuff for the long run, which is why having a lower expense ratio matters so much. Before we wrap up today, we're going to go over one more ETF that gets a honorable mention because it's so popular. In fact, it has $1.5 trillion of assets under management, which means that there is that much money invested in this fund. That is a whole lot of money. And that is VOO. It has an expense ratio of 0.03, and it tracks the S&P 500. It's arguably the most famous ETF. There's a saying called VOO and chill, which is like buy the S&P 500 and forget about it. But that's just our fun shout out for this week.
Yeah, and it's managed by Vanguard.
Yes, it is.
Yeah, and it tracks the S&P 500.
Yes, it does.
Yeah, so this 1.5 trillion, did you say?
Yes, it's a whole lot. It's the largest ETF.
Crazy.
Yes.
Can you pull up what its volume is?
Yes, it's actually 10 million shares per day. So it's less than both SPYM and SPY. So it's definitely for people who want to buy and hold.
Yeah, so
that
people
ETF.
are really doing, VOO and chill.
Yes,
Is it
yes,
VOO
they're
and
not.
chill?
Yes, yeah. But yeah.
Yeah, so I guess that if somebody wants to read more about this article.
Yes.
Because, again, this is just the spine of our article.
Yes.
Where would they go?
So you can check out the link to the Niner Times article in the description, or you can go to awmfinancial.net for more resources and content.
Yeah, sounds good.
All right. See you next time.